Hey there, friends. Today we're diving into the most pressing topic I've been getting messages about lately, stablecoins. And trust me, this isn't some niche crypto gossip. This is the story of how governments, tech giants, and traditional finance are waging an all-out war for control over the future of money itself. Back in May, the US Senate made a historic move, passing a key procedural vote on the Stablecoin Genius Act. Within weeks, Hong Kong followed suit. Then Europe, Singapore, the UK, South Korea, all launching stablecoin legislation. And here's the kicker. Even Pan Gongsheng, the governor of the People's Bank of China, publicly discussed stablecoins for the first time in June. On the market side, Circle became the first stablecoin company to go public, with its stock skyrocketing 750% in less than a month. The Trump family launched their own stablecoin. PayPal, Stripe, JP Morgan Chase, Goldman Sachs, the financial elite are rushing in. Even domestic giants like JD.com, Ant Group, and Xiaomi are already making their moves. Now, I know what many of you are thinking. Isn't this just crypto hype, another money-making scheme, or maybe it's just a US trap? But here's the thing, think about it logically. If so many governments from so many different countries and regions are moving in this direction, if so many mainstream companies are betting billions on it, is it really possible they're all chasing a scam? That they'd knowingly walk into an American conspiracy? Something bigger is happening, something that's reshaping the financial world as we know it? Okay, let's start with the fundamentals. Stablecoins are cryptocurrencies built on blockchain, just like Bitcoin and Ethereum. The key difference? They're stable. Most are pegged 1.1 to the US dollar. Right now, any private company can issue one. The largest is Tether's USDT. Here's how it works. You give Tether $1, they take your dollar and create a stablecoin on the blockchain worth $1, which goes into your wallet. From there, it moves freely across crypto networks. You can pay, trade, invest, whatever you want. The clever part is how they guarantee that stability. Tether operates on a simple principle. They can issue coins at $1 and redeem them at $1 with no quantity limits. This creates a natural market equilibrium. If the price goes above $1, arbitrageurs buy from Tether and sell on the market. If it drops below $1, they buy low and sell back to Tether. The market automatically locks the price around $1. Here's the secret ingredient: reserves. Every coin issued requires at least $1 in assets held in reserve. When Tether issued 143.68 billion coins, they held $149.27 billion in reserves. They're actually $5.6 billion richer than they need to be. Think of it like a company issuing game coins backed by real collateral. It's not mystical, it's straightforward. Now here's where it gets interesting. Tether's profit last year, $13 billion, for a company with just over 100 employees. That's more than $100 million per person. How do they make this money? Simple. When you give them your dollar, they invest it, usually in extremely safe short-term US Treasury bonds or overnight repurchase agreements. With current interest rates so high, the returns are substantial. At 4% interest on $150 billion in reserves, that's roughly $6 billion annually. That's the stablecoin business model. Currently, two companies dominate the space, Tether holding about 60% of the market, and USDC from Circle, which just went public, holding 24%. Both operate on the same centralized reserve-backed model. Here's the irony. Blockchain was supposed to be about decentralization. Yet the stablecoins that dominate the market are completely centralized, issued by corporations, backed by companies, subject to government regulation. So why the sudden global frenzy? Because stablecoins possess three extraordinary features: convenience, privacy, and stability. Convenience is most obvious in cross-border payments. Traditional bank transfers can charge 5% or more and take days. Stablecoins, minutes, no banks, no SWIFT. No exchange rate headaches. Privacy works like trading game coins. You only see usernames, not real identities. Yes, the blockchain is public, but you're not directly tied to it. Stability solves Bitcoin's Achilles heel: volatility. Bitcoin is revolutionary but impractical as currency. Stablecoins, they're ideal transaction money. Currently, stablecoin trading volume has exceeded $27.6 trillion in 2024 alone, already surpassing Visa and MasterCard's combined annual payments. The market has grown over 20 times in 5 years, now topping $250 billion. This growth is driving three massive economic activities. First, the black market. Criminals love stablecoins for the same reasons legitimate businesses do. They're fast, private, and stable. Second, legitimate cross-border payments. A year and a half ago, this was nearly zero. Today, it's $50 billion monthly, growing 20-30% every month. Third, in high inflation countries like Argentina, Nigeria, Brazil, and Turkey, people are using stablecoins as a de facto digital dollar to escape currency collapse and capital controls. These governments initially tried to ban them, but demand was too strong. Now they're embracing it. Brazil connected stablecoins to its official payment system. Here's where geopolitics enters. The real question isn't whether stablecoins are good or bad, it's who controls them. The US under Trump has made its position crystal clear. First, he signed an executive order on strengthening America's leadership in digital financial technology. Then he issued his own cryptocurrency, though not a stablecoin. His son and wife launched their own. His company issued USD1, which exploded from $100 million to $2.2 billion after Abu Dhabi invested $2 billion. The real bombshell? The Genius Act. It's called that because the abbreviation is genius. It passed the Senate with strong support. A 20-30-page bill with standardized requirements. Companies need licenses, 100% reserves in high-quality assets, strict reserves for stablecoin holders, paid first if the company goes bankrupt, compliance with anti-money laundering laws, and detailed reporting. China, meanwhile, bans cryptocurrency broadly but is piloting offshore RMB stablecoins through Hong Kong. Hong Kong launched its own stablecoin bill in May. JD.com, Yuancoin Innovation, and an alliance of Hong Kong institutions got the first licenses. Ant Group is eyeing the next round. Europe, more cautious. Its MiCA regulations prohibit stablecoin fees, forbid paying interest, and strictly limit daily trading volume. The subtext: we're regulating you, but we're skeptical. Singapore and the UAE, wide open. They're competing to become the global crypto hub. Why is America rushing this agenda? 3 reasons. 1. Strengthen the US dollar. With de-dollarization accelerating globally, stablecoins, 99% of which are dollar-pegged, reinforce dollar hegemony. If countries use dollar stablecoins instead of their own currencies, they're essentially dollarized. 2. Boost Treasury bond demand. As stablecoin reserves swell, demand for short-term treasuries grows. Treasury Secretary Yellen estimated that by 2028, stablecoin reserves could exceed $1 trillion, creating enormous demand for short-term government bonds. 3. Dominate the crypto world. The US won't allow crypto to exist outside its regulatory framework if you can't beat it, regulate it, and lead it. Here's what's fascinating. Compliance has become the new competitive advantage. Companies like OKX paid $84 million in fines and gave up $420 million in revenue to achieve US compliance. Why? Because compliance equals credibility. Exchanges that achieve licenses in America, the EU, Singapore, and Dubai gain massive trust. OKX is rumored to be considering a US public listing, unthinkable for a crypto exchange a year ago, but now listing on US markets is the gold standard credential in crypto, signaling to users, regulators, and governments we're legit. Circle and Coinbase understood this early and became good students of compliance, seizing most of the mainstream market. Make no mistake, stablecoins aren't just another financial innovation. They represent multiple collisions. A collision between currencies as different countries compete for influence, a collision between traditional finance and decentralized crypto systems, a collision between private companies and central banks, a collision between stability and innovation. Banks are nervous because stablecoins enable financial disintermediation, skipping them entirely. Jamie Dimon, who called Bitcoin a scam 2 years ago, now promotes JP Morgan's own stablecoin. By the end of 2025, Major global banks will have launched their own. The uncomfortable truth? Regulators in most countries still don't fully understand what they're regulating. They're deliberately avoiding hard questions about monetary policy, credit creation, and economic impact in a world dominated by stablecoins. Stablecoins are genuinely fascinating and complex. I'm certain I haven't covered everything in one video, but my hope is that you now understand this isn't hype. It's a global competition with real stakes. Governments, tech giants, traditional finance, everyone is moving because they sense something fundamental is shifting. Whether you think that's positive or terrifying, one thing's certain. Stablecoins are reshaping our financial future right now. What's your take? Let me know in the comments below.